I'm Charlotte McLeod with the Investing News Network, and here today with me is Don Hansen. He's a private investor who's been investing in the gold and silver mining companies for 21 years. Thank you so much for joining me. It's great to have you here.
Oh, I'm delighted to be able to participate. This is going to be fun.
It's going to be fun. And just for our audience, a little bit of context on how this conversation came about. So you ended up meeting one of the partners at INN at PDAC, and he told me that I had to talk to you about your due diligence process for looking at companies in the mining sector. So I reached out to you, and luckily you said you were okay to come on and talk us through it. So we're going to get into that. But before we do, I thought maybe you could tell us a little bit about your background and how you got interested in the mining sector.
Okay. Well, my education was in engineering, and then I got a master's degree in business. And I was co-founder of a manufacturing company back in the 1970s with two other engineers. And our company manufactured stained glass. And so that was very successful. We patented a new way to produce the product. And it was a glass 1/8 inch thick, 2 foot by 4 foot sheets. We made all different colors, mixtures of colors and textures. And I managed that business for 25 years as the president and the plant manager and the chemist also. And in 1999, I chose to sell my interest and retired after a couple of years, so that my last paycheck was in 2022 or 2002. I mean, so that was the 21 years. And so then after that, I had money to invest because I sold my interest in the business, and I got interested in silver, and began reading about that. And of course, the price of both gold and silver was very low in 2002. Silver was about $5 an ounce. Gold was maybe 300, something in that range. But my primary interest at that point was in silver, so I actually bought a lot of silver bullion at that point for $5. And then in 2011, when the gold silver ratio became very low, it was down to 33, which is a very low number. I actually traded some of my silver for gold bullion, and I bought some gold maples, which I still own. So and then, of course, things changed in 2012. And instead of a bull market we had in 2002 and 12, where I made a good deal of money investing in silver miners, I became more interested in gold because it wasn't as depressed. But during that decade, I didn't do particularly well, as I don't think most other people did either. But now we're in a new phase. And so I'm excited again, and was very sorry that the pandemic happened, because I started to get interested again in buying miners in 2020. And went to the Resource Investment Conference in Vancouver at that time, and also this Metals Investor Forum thing with newsletter writers. And that's where I met Sean Tufford, who was doing investor relations for Erdene. And of course, Sean is then he and I spent the week here at the recent PDAC, and he went around and introduced me to all kinds of people, one of which was your Chris Smith. So that's how that connection happened. Yes.
Okay, thank you for sharing your background. I think that helps us understand a little bit about who you are and why you're interested in mining. So now I want to get into your due diligence process. And where I want to start is you have a particular way of quantifying risk and reward. So we'll be bringing up your chart on the screen here, but if you could walk us through your strategy there.
Okay. Well, of course, the real issue that we work with in making a decision about an investing, or lots of other choices that we make, we're always, whether we recognize it overtly or not, we're evaluating the potential reward and also the probability that that reward will happen. And so what I wanted to do was to find a way to quantify that. And I actually learned a technique called expected value back in 1970 when I was in the business school. And I've used it ever since. And basically what I'm doing is, if I'm looking at a particular mining company, I will assess what I believe will be the result of that investment over a 2-year period, and what would be the best result that I could imagine. And then I project what I think the probability of that investment achieving that result will be, multiply the two together and get a number called the expected value. And so if you look at the chart, when we pop it up, you can see, I'll describe on that chart 6 different situations that you would encounter in investing in gold and silver. And then I'm doing an estimate of what I think the best potential result would be. For example, the one at the top will be exploration type mining companies, okay? And so then I'm put in the very best expectation that I could achieve, which would be 20 times my money. But the other thing I'm assuming going into this is that the gold price will appreciate over the next 2 years from $2,000 to $2,500 per ounce. So that's built into this, okay? And so then you'll also see on that chart where then I'm saying, well, what is the probability of that happening? And I assign a 5% probability, and that's probably high because it's very rare for companies to go out and be successful from the beginning for so many reasons. I mean, there could be a good project, but if they don't find a lot of gold right away, they could run out of money. And that happens more often than not because the market isn't very strong. And there's now, in fact, hundreds of mining companies propping up that all want to go out and drill holes and find gold and silver. And so they're all got this same wonderful story that they're all trying to convince you to give them money. So there's a lot of competition for the money. And so anyway, that's why I think the probability is so low, and the experience that I've gained over the 20 years I've been doing this and learning from other people. So that's the first item on the top. Then the one at the bottom is the lowest risk version of how that, and that would be the royalty and streaming companies, which I note is Franco-Nevada, Royal Gold, Wheaton Precious Metals, and that is absolutely the lowest risk, primarily because they're not even miners. They're actually investment bankers. And so they have much less risk, and they invest in a lot of different projects. So they're very well diversified. So very minimal risk, although there is some risk because some of them invest in projects that don't work and then they lose their investment. But that's fairly rare. So, and then there's another group in between. So if we look up that chart, maybe we can talk about that. And you can ask me about that and why I have show what I do.
All right, we've talked about the top end of the risk reward and also the bottom end, but of course there's the middle. So let's take a look at how that looks.
The next risk category below explorer is explorers that have sufficient drill results to convince investors that the project will become a mine, but they don't have any 43-101 or PEA, preliminary economic assessment numbers and whatever. And so I'm giving the probability of that one as 20%, but with a 6 times appreciation, okay? Then the next one is where they have a 43.01 and a pre-feasibility study, management team that's obtained drilling and permitting and financing, and production in 2 years with growth potential. And then I'm saying, well, that potential, well, that one is 4 times with a 50% probability. Okay, so the probability is getting bigger as we go down. Then the next one is one that's a company that's in production and has potential to increase by 2 to 3 times their production. And I'm also giving that a 4 times with a 60% probability. And then there's another one here, small royalty company with top management and strategy. And I have a particular company in mind when I'm saying that, because I don't only know one. And that's be 4 times with 60%. And then, so in other words, that would be a 2.4 expected value. Then there's producers whose primary growth is by acquisition. And I say the probability of that would be 75%, but only a double, only 2 times. And then the bottom one is the large royalties. And I'm giving a gain of 2.5 times, but with a 90% probability. So that would be like a 2.25 number. So the ones, of course, that I like are the ones over 2. And I should maybe also explain how I use that in terms of telling people when they ask me, okay, if I'm going to get into investing in these kind of companies, how should I approach that? And basically what I do is talk about it in terms of the risk pyramid. Okay. At the very bottom, what I don't show there is gold and silver bullion. That's the only risk then is the price of gold and silver. And you really want to start there. And that's the bedrock. That's where you want to preserve your wealth. And just as an example of how powerful that is, primarily with gold, which is the wealth preserver, as an interesting statistic that I ran across where it said that in 1913, 110 years ago, when the Fed started, the price of gold was $22 and the price of oil was $1 US. So an ounce of gold would buy you 22 barrels of oil at that time. This year, the recent gold price has been in the 1850 range, say approximately, and the price of oil has been in the 75 or 80 range. If you do the math, that's about 23. In other words, over 110 years, the most important commodity in modern civilization, which is oil, has been able to produce, an ounce of gold has been able to produce the same. In other words, that's wealth preservation. And that's why you want to own gold. Silver is more volatile and more of a speculative investment, in my opinion. And the reason for that is that silver is unique in that it is the only metal that we take out of the ground for which the amount that's produced every year is not price sensitive. And you may say, oh, because everything else is, of course, when the demand goes up, the supply goes up and vice versa. That's not true in silver. And the reason is that 70% of all the silver produced is a byproduct of something else. So if you're a copper producer and the price of silver goes up, you don't produce more to get more silver. You just focus on the copper. So that's why that you see such volatility in the silver price.
So this risk reward, this is the first step for you when you're doing your due diligence. You also have analysis that you do on market cap and gross margin. And again, you have some charts that we will put up on the screen. You've done this for gold miners and you've done it for silver miners. So I was hoping you could talk us through how you do this calculation and what it tells you about these companies. That's important for you to know.
Absolutely. And I should mention that the expected value calculation is actually the last thing I do. I do all the other analysis and research before there. And then it becomes then a way to actually have a proper input into what I think I might expect would be the best outcome. But I have to do all the other homework first, as well as the probability that might be successful, again, because I have to know all the other things about them. And the circumstances, and every one of the companies are different. So that's why it becomes the last thing. Okay. So in terms of the market cap to gross margin analysis, what I do for each company, I go to the corporate presentation. And these days, with the internet being what it is, every company, even small ones, have a very good corporate presentation that tells you all about them. How many shares are outstanding and fully diluted. I always use fully diluted. And then at the time, I will find the share price and multiply that, and that gives the market cap or capitalization for that company at that point in time. So that's the first item on that list. Then the other part is basically I'm calculating my version of what would be a price earnings multiple. Only I've got the price being the market cap and the earnings. I don't go into the effort of finding the actual earnings because I don't want to spend all the time to go into CDAR and pour over the P&Ls and all that, because every company that's producing or even planning to be produced will provide us with what they call an all-in sustaining cost of production. And they all do that now, and you can find that very readily. So I use that number, and I will then multiply that number times the number of ounces of gold, for example, that they're going to produce and sell. And so then that's my cost, total dollars. And then I'll multiply, in the case of what you're showing, $1,800 gold price times that same production and sales number, okay? And that will give me a gross margin. That is the margin between, and I call it gross margin because that's not all the costs. There's also going to be G&A, general administrative, legal and accounting and interest expense and officers' salaries, all that stuff. So that's another increment. In silver, that would be about $2 an ounce worth. and gold maybe $150 an ounce, but something like that. So, but it's very convenient to do it this way because there's a lot of other stuff that changes and it's a lot harder. This is it easier and it gets me close enough to what I want to see to just use the all-in sustaining cost. So then I get this gross margin number, and you'll see that then on that list. And then I take the market cap in the numerator and the gross margin in the denominator and get a ratio. And so that's the ratio that you're going to see on these charts. Also on the charts, I'm showing what that all-in sustaining cost is. And they also show the all-in sustaining cost, which is for gold, actually averaging around 1,200, 1,250 per ounce. And that's, so gold miners are making good money there because it's 1850. So they got it. And they're making good profits. And a number of the larger gold miners are actually paying dividends. And so is the royalties. So that's another reason for the people that buy it and hold it. People, they're getting something just to wait as well because they're making money. In the silver side, you look at the all-in sustaining costs over there at $22 silver. There's several of those companies that aren't making any money at all because their all-in sustaining cost is like $19. And then you add in the G&A, there's no profit there. So that's why you are going to see on these charts where the multiple on the silver miners is over twice what it is on the gold miners. And that's because the gross margin's in the denominator and there's so little profit that it makes it look really skewed. But the interesting thing I did, because I've been doing this a long time, I went back in my files and I looked at the calculation for silver miners in 2011. And it was roughly the same ratio as what I'm seeing now on the gold miners, because they were making good money back at that time when silver was $35 or $40. So we'll see that on the charts when you show them how the average, because I'm taking all the gold miners and average out the multiple, which is 7.5, and then I average out the silver miners, and that's like 20. And then I leave out one of the silver miners, and I'd love to talk about that one because it's very interesting, and it happens to be my absolute favorite investment at the moment, which I learned about and actually had a face-to-face meeting with the CEO at PDAC, and it's an extraordinary company.
Yeah, why don't you tell us about that one? Because I think that's something that people would definitely want to hear more about.
Okay, would you like me to do that now?
Please, yes.
Okay, I just learned about this company in 6 weeks ago, when a man named Rick Rule had a podcast deal called Silver Boot Camp, and he had different speakers on it. And one of the speakers was the CEO of a company called Aya Gold and Silver, AYA. And so I thought, I was so impressed with it that I bought quite a lot of it. And it is up 30% in the last 6 weeks. Silver's been doing well. But the thing that is unbelievably interesting about that is that in all this time that I've been investing in silver miners, it is the only company that I have ever run across where 100% of their revenue comes from silver. If you will look on the papers that I'm showing you, it has actually on the left side, the percentage of silver that is the revenue for the company and how percentage of gold. And the average on those, everybody else is like 50% is silver revenue. And in Pan American Silver, which has silver in the name, it's only 25%. And of course, a lot of the reason for this was that silver price was so bad for the last 10 years that these miners actually went and got a gold project so they could survive, or they went out of business. I mean, there isn't also only a few silver producers on my list because there aren't very many that even say that they're producing silver, but it's only like half of their revenue. But this Aya, it's 100%. And so that, if you like leverage to silver, silver price, then that's your thing. But there's a lot of other things that are interesting about it too. And I'll be happy to talk about that. But one of the things I like, the location, it's in Morocco, which may be in Africa, but it's up in the northwest corner of Africa, right close to Spain. And it's a very stable country, lots of mining going on there. Morocco is the largest producer of phosphate, which is very important in fertilizer. And then most of the border of it is the Atlantic or the Mediterranean oceans. To the south, there's a row of mountains called the I think it's Atlas Mountains, and south of that is the Sahara Desert for like hundreds of miles. So, and to the east is Algeria, which is a very prosperous country. So in other words, it's a safe place, and it's a Muslim country, but at least half of the legislators in their legislative body are women. So it's not, an Iranian type kind of Muslim country. It's very European, and yeah. So enough about that. But anyway, that's why I'm excited about that company, and why then when I do my calculation of my expected result, best expected result times the probability, I get over 3.
Okay, that's really interesting. I like that you have an example that can show exactly how this process works.
Yeah.
I wonder if you want to talk a little bit more about, so we've looked at your calculations and all these different things that you do. We're kind of getting into now other elements of due diligence like management, jurisdiction. Maybe you want to talk a little bit more about that and some of the questions that you think it's important to ask of these companies.
Oh, absolutely. And I've always learned over my lifetime that actually the most important thing when you do analysis is not finding answers. It's asking the right questions. So then so that you need to really focus on that, and you need to make a list that you refer to every time you analyze a new company, and so that you then make sure you don't forget any. So that's a discipline that I try to follow all the time, because it's easy to forget them. And it's also why I like to go to places like the PDAC, because then I'm all primed with all the questions, and I ask the management, and I really like to do that whenever I can. But I could go through the questions. Of course, management is an enormous item. So I like companies where the management has not only done mining projects before, but preferably they've done the same metal in the same general location. Like maybe they've done all these projects, and they're open pit projects in Mexico. I have a company that I like a lot called Minera Alamos, where they've done it before, and they are really good, and they've done it in Mexico, or it could be in Quebec or whatever. But I like that. Another one you want to look at is location. You want to be very concerned about the country that you're going to go in. You don't want to go into Venezuela or Russia or Argentina either. I mean, these are all issues that are problematic. And sometimes this kind of even changes. One of my favorite companies was in Chile, and it had a management that had done it before, and the same type of project and everything. And the government changed, and the new government rejected their permit because the previous government said that they did all the environmental stuff just fine, and the new people bumped it. And so I'm way underwater on that company. So that there's a reason why I don't ever put 100% on the probabilities. But so that's the location. The other piece that's important is, do the people who are financially supporting this company, do they have deep pockets? Are they going to be willing to pony up for the next round of investing? That's especially true with the explorers, because if they don't find gold or silver right away, or insufficient quantity, and the market's weak, then they go out of business. And that happens painfully frequently. But then there's also, for example, in gold, is it an open pit or an underground project? I very much prefer open pit because there's so much less risk in it. You need to do drilling. You got to do more drilling because you got to go deep, deep, deep. Whereas with the open pit, you're only going down maybe a few hundred meters. In the underground, it's going 800 meters to a kilometer. And so you got to spend a lot more money drilling, and you got to drill it tighter together. And then if you're going to build a mine, the underground mines are going to cost you at least twice, maybe 3 times what it would cost you for a similar amount of production. So one of the things I look at in looking at developers is, what is the amount of CapEx that is going to produce how much gold? For example, if I wanted 100,000 ounces of gold from an open pit, I would not expect the CapEx to be more than 100 to 120 million, and that ratio. Okay, about $1,000 to $1,200 when you do the math. Whereas the undergrounds are going to be much greater than that. And one of the things I worry about then when I see an open pit project that comes in with a PEA and that's 2.5 times, which I did recently with one, and I'm going, oh my God, what happened here? And in fact, I sold half of it already because when I talked to them at PDAC, I didn't get any good answers. But that's another whole story. But that's why I favor the underground open pit. The other problem I get into is there's so many things that can go wrong underground. One of which is you can drill down and find you get below the water table. And then you got problems with that. You also have problems and you're boring down to get down to where the ore is. And if the soils are too loosey-goosey, then they keep wanting to collapse. And then you got to build up a whole structure around that. It gets very expensive. And then the other difficulty you get into is with the underground, the veins can be very high grade, but they're too narrow. And so that when you bore down, when you take the material out, too much of it doesn't have any gold in it at all. Whereas with the open pit, they tend to be a lot of continuity. So you can go over hundreds of meters and you're still going to have gold grade that's between 0.5 gram and 1 gram. So it's very continuous. So you don't have to worry about that, nor do you have to do as much drilling because there's so much more continuity to those. So I'm very much in favor of the whenever I can find a good open pit project, that's the one I really focus on, is that you have less capex, you have fewer potential problems. And so that's my own bias. Not that there aren't phenomenal underground mines out there, but my experience is I have not made much money on underground projects unless you're investing in one that's already producing and they've proven that everything works. But it's a number of issues there. So the questions you get into then, was they say that when you look at a company is, well, what's the width of the veins that hold the metal? So you want to know that. You want to be aware of that, as well as the soil conditions and the availability of the water. And then the infrastructure. Is there roads there? Is there power there? Is there water there? And how remote it is. I mean, one of the things I've learned is I'm very skeptical of investing in companies in like the Northern Territories in Canada, because they're so remote. You have to fly in people, you have to fly in diesel, you have to fly in everything. It's extremely expensive. So, and year round is difficult to do unless it's an underground, then you can kind of make it work. But I don't like those very much. I'm much happier being in places like Nevada and Mexico, where you can basically work 12 months a year, more or less. I mean, there's monsoon periods in Mexico where you can't work, and there's some snow in Nevada, whatever, but they're much easier places to work.
I think those are some really good questions. I think if people are making their list, that's a really good place for them to start. I want to go on just a small tangent and ask you about when you decide to sell. So you're crunching numbers, you are asking questions, and you told us the story about how when you didn't get the right answer to a question, you sold half the shares that you owned. I think this is one of the hardest things for investors to do, is to make that decision to get out, because you might think that there is still more to come. Maybe it can turn it around. So how do you approach that?
Well, I have to confess that not only is it hard for other people, but it's been the hardest thing for me. It's not easy. And you sometimes get in love with a particular company because you really like the management, it's doing really well and da-da-da-da-da. But you really need to it's so individual. Also, what is your need for money as a person? Okay. You may have different life circumstances and all of that. And so that all ties into it. The other thing is, what is your macroeconomic outlook? What do you see as where things are going? Right now, I see that we're headed into a significant inflationary period that could very easily last for 10 or 15 years. And that's because of a number of things. It's because of the demographic shift of the world's population. And it's because of the enormous amount of debt that has been built up in personal, corporate, and government levels. And particularly with government levels, that we're not going to be able to defeat inflation by doing what Paul Volcker did in the 1970s. In the 1970s, the US GDP, the debt to GDP ratio was 30%. Today, it's 120%. If you raise rates high enough to defeat inflation now, the government will bankrupt. They can't, the interest expense will be so large. So it's not possible. So it's, and the way that the US government got out of that predicament after World War II was to basically hold interest rates down and let inflation rip for a number of years to where the ratio of debt to GDP, then the economy grew because you had a growing population. So all the things were right for that to work then. They're all wrong now. So that's where my primary focus is. And I'm trying to follow that and make sure that that's still on track. Am I still right about that? I'm quite sure at this point that I am, and that we're going to start to see a major improvement in the gold and silver prices as a result of all that. So I would expect, if we look at historically what gold and silver bull markets have done, for example, in 2002 to 2012, gold went from $300 to $1,800, right? About 6 times. Silver went from $5 to 40 some dollars, so 8 or plus times. And I expect, and it was even more extreme in the 70s. But that's because we came out of a period where Americans couldn't even own gold from 1933 to 1971. So there was a lot of pent-up demand for it. But what would happen this time, I think we would probably do at least as much as what we saw between 2002 and 2012 in this next period up, which would mean that we could expect the gold price to go, if you look at the bottom as $1,100 gold in 2016, something like that, and it went up 6 times, you can see $6,000, $7,000 gold as a peak. And even more than that with silver, because it's so depressed now. And it will do a greater than that. But on the way up, I would be selling some, which I didn't do very well. I did some, certainly, because I took a lot of money off the table before the market went down in the toilet in 2013. But so there, it is smart to take off money, take off 10% this year and 10% next year, even as you think it's still going to go up. You really need to do that. I think, not try to, ride it all the way, and that is not a smart thing to do. I don't think is take profits along the way, and keep riding it if it's going up and everything works, but still take money off. Then the challenge, though, Charlotte, so you take the money off. So then what do you do with it?
Right.
And that is in itself is a challenge. But over the centuries, families have maintained their wealth by holding gold and property. And so maybe you buy some more gold. Maybe you buy some land, some farmland, or good real estate that you don't have any debt on. But that would be where to put the money. But that's the big challenge in these inflationary environments. You say, sure, I'm going to take money off the table, but then what do I do? And so, yeah, it's a challenging time, but investing is always challenging. But that's for me what makes it fun.
Well, thank you so much for joining me, John. It was great to hear from you. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Don Hansen.